You know, we hear so much about the AI revolution, these incredible new models, the mind-bending things they can do. But what's the one thing, the one single resource that actually makes it all happen? It's not just code. It's not just silicon chips. No, it's something way more fundamental. It's the raw ingredient this entire digital world is built on. So, what truly fuels this revolution? I mean, what is the one physical thing that these gigantic data centers are just gobbling up at an unbelievable rate? The answer? It's power. An absolutely incredible amount of power. We're talking about an energy demand that's so explosive, it's forcing a complete rewiring of our electrical grid as we know it. And to put a number on it, get this, 48 gigawatts. That's how much power data centers have already signed up for in just one utility's territory. We're talking about Dominion Energy in Virginia. Just to give you a little perspective, that's enough electricity to power tens of millions of homes. It's staggering. So that brings us right to our first topic, powering the AI boom. See, Virginia happens to be home to the largest data center market on the entire planet, and having them all in one place is creating this unprecedented surge for electricity. The challenge here is immense. How do you keep the lights on for everybody else while also fueling this digital gold rush? Which, of course, leads us to Dominion's response. Section 2 is all about Dominion's $65 billion answer. Faced with this historic demand, the company has rolled out a massive spending plan to try and meet the moment. And just look at the sheer scale of this jump. We are not talking about a small tweak here. Dominion is boosting its 5-year capital plan from $50 billion to $65 billion. That is a 30% leap. It's an enormous bet on where energy demand is headed. And this quote from Dominion CFO Stephen Ridge really gets to the heart of it. He says, "We're seeing the need for incremental investment across our system to ensure continued reliability amid continually growing demand." In other words, he's saying the demand from data centers is so intense, they have no choice. They have to build, and they have to build right now. So a $65 billion check is one thing, but where does all that money actually go? Let's take a look at how they're building the future grid. Well, the absolute centerpiece of this entire strategy is a massive offshore wind farm. It's called the Coastal Virginia Offshore Wind Project, or CVOW, and it is one of the most ambitious renewable energy projects anywhere in the country. And this isn't just some idea on a whiteboard. They are making real physical progress. All 176 of those giant foundational monopiles, they're installed in the seabed. The 3 offshore substations, they're in place. The work on shore needed to connect it to the grid, it's done. They are on track to deliver the very first power from this project by the end of March 2026. This is happening right now. And the price tag for just this one landmark project? A cool $11.5 billion. It's a huge slice of that total spending plan, and a giant step towards generating cleaner energy to meet all this new demand. Okay, but this brings us to a really important question. Let's look at Section 4, funding the growth. How in the world do you pay for a $65 billion plan? Well, how they're financing it is pretty telling. The key thing to see here is that they're funding the majority of it, almost 60%, from their own cash flow. Money from their day-to-day business. But that's not enough. About 20% has to come from new debt, and another 20% from issuing new stock and other things. Bottom line, they have to go out and raise new capital from the market. And when you raise money by issuing new stock, that leads to something called equity dilution. And honestly, this pizza analogy is perfect. Think of it like this. If your company is a pizza and you need more money, you just slice it into more pieces to sell to new people. The only catch, your original slice just got a little bit smaller. It's a totally necessary way to fund huge growth, but it always has an impact. And this really gets to the core trade-off that Dominion is navigating. On one hand, they have to invest all this money to fund a 10% annual growth rate and meet real customer demand. But on the other hand, doing that means they have to issue new shares equal to about 2.5% of the company's value every single year, and that dilutes the existing shareholders. It is a very delicate balancing act. Okay, so we've seen the massive plan and the tricky trade-offs. Let's move on to Section 5 and check out the financial scorecard. How are the numbers actually stacking up? Well, their most recent quarterly results were really strong. They beat Wall Street's expectations on both their earnings per share and their revenue. Now, that's a big deal because it provides a solid financial foundation, and it shows they've got the muscle to actually execute on these incredibly ambitious plans. And you can tell management's feeling pretty confident. They've reaffirmed their long-term earnings growth targets, and they're even hinting they'll be in the upper half of that range starting in 2028. On top of that, they've achieved their strongest credit metrics in over a decade. The message they're sending out is loud and clear: we can handle this. So as we wrap this up, it all comes down to one big, lingering question. We know the demand from AI is real, and we know Dominion's plan is in motion. But can they build this future grid fast enough to power the AI revolution while also keeping energy affordable for everyone else? That right there is the multi-billion-dollar question they're racing to answer.